So you've had success in these other industries, and that led you to trying to figure out efficient uses of capital. I've told people this on the podcast before. I am like an obsessive optimizer. One of my most favorite things to do is optimize. I tell people that there was a concept in video games called min-maxing, which I was a huge fan of doing in every video game I've ever played. I would literally go to school and I would use formulas and math to figure out like the best builds of different characters and games, just so that I could go home and make that thing work and hum and things like that. So I've always been a fan of min-maxing. In terms of you going out and finding uses of capital, it sounds like a little bit of what you looked for was, a min-maxing of how to utilize your capital in efficient ways. So talk to me about alternative investments and how that fits into your criteria of doing all these types of things.
Yeah. So those previous illustrations of kind of private local businesses was fun, but as I already said, it did require or request at least some of my time, even if it was just a phone call and conversations. It wasn't something that I could have scaled indefinitely. If I had 20 different things like that, I would have no time. I'd literally just be meeting to meeting. So part of my pursuit was, okay, like these are great. I've gotten somewhat lucky. I do think I had good selection and all that, but there's some luck involved with finding the right partner and the right location and the right franchise and all that kind of stuff. Not wanting that to be my path moving forward because I just knew it wasn't going to scale. I needed to find ways to actually have passive investments and passive income. And the most common way that people do that is just public markets, stock market, brokerage accounts, all that kind of stuff. And that's about as passive as it can get, but it has a relatively limited window on the returns that you get there. Obviously, if you pick the right individual stock, you can do whatever with that. You could either go to zero or go to the moon. But if you do kind of the prudent, kind of most mass affluent suggested thing to do, index funds or ETFs or mutual funds, whatever you want to do, you're going to get a relatively tight window of return, somewhere in the 7 to 12% range or whatever any individual year gives you. Some are way up, some are way down, but that's the range that people would broadcast for you there. That's great. I do have some of that in my portfolio. I'm not saying I wouldn't do that, but I wanted things that would still feel like that private market local thing, but be on a better institutional partner with tons of capital, tons of history, and big projects. And then the more important part to me was, as I was learning these things that they existed, some of them have tax things that go along with them, where it's not just, your after-tax dollars going to work for you and create more taxable dollars. Some of these things can actually help you with your taxes, either your active dental income, your owner income. If you have real estate is one of those things where you can really supercharge what your write-offs and stuff are. But even if you don't want to do that, there's things in oil and gas and other ways that you can have some depreciation on the dollars that went in. So your immediate return is in year one, maybe 20, 30% because of the way that you actually on paper invested those dollars. So anyway, I know that's a lot I said there, but feel free to dive into any that you want to. But that was my next evolution, is let me find ways to actually leverage dollars and not have time be part of that equation for me.
Yeah. So in terms of what you just said, I'll repeat it back, is you have funds, you can either sit on those funds and just cash, or you can go the traditional route, which is go look for 7 to 12% returns through the traditional markets, which if you go with the premise of, hey, it's always done that, so I can assume it will eventually do that if I just dollar cost average over a long period of time, then you can go into the public markets. If you don't like that, then you can start going with other investments, which could be things such as real estate, which is a very common second level kind of investment that a lot of people do. I have rental properties and things like that. And I can tell you it's passive activity. It's definitely not passive, right? We're 8 months into a rehab right now on a tornado property in a nice area here in Little Rock. And I've probably visited that house 10 times this month alone, just to deal with contractors and all the things that go along with it. So that requires time. Another category is what you're saying is we should define what I mean by alternative investments when we say that. Alternative investments means basically it doesn't fit into the criteria of being like a publicly traded stock typically, and it doesn't fit into the criteria of being like you go buy a rental property and you're the owner of the property. Maybe you have a property management company that helps you find tenants and manage it, things like that, or maybe you do it yourself. Maybe you got Airbnbs or whatever it may be. We're talking about other investments that can be things like, people that are operators, like you've said you found in your other businesses, and you're effectively investing in those other businesses. But usually these that we're talking about are much larger scales than, say, it's just some person that wants to, own a franchise of a restaurant of some kind, right? We're talking about other types of things like that. Is that a fair like definition of what an alternative investment is? And there's a bunch of different categories of these.
You said it well. It's just private market investing. It's not typically advertised on TV. It's not sold to you by a broker or your investment advisor. Like these are often things you have to either go find on your own or, have networked to find them. And that's kind of where I've, over the last 7, 8 years, have drilled down and gotten to the right people. I made some mistakes early in who I partnered with, and some of those weren't good returns. Some of them were negative returns, but ultimately finding the right people at the right scale with the right longevity, all that kind of stuff. You start to figure out what matters and who you're partnering with to make those investments. And I feel like I've landed in the right place now and finding the right people to partner with to make that thing happen. And so that's kind of part of what I'm doing now with my group that I have, Legacy Point Group. So I don't pretend to be any sort of investment advisor. I don't have any credentials. I'm just a dentist. But as a colleague who has done this for now the better part of a decade, like I said, I feel like I've weeded through some of the things that might be worth avoiding to get to the right people who are worth partnering with. And so that's what we're sharing and talking about in that group. And so I've got CFPs and RIAs and people who have those things. And so the whole point of this group is just connection and opportunity and discussion around finding what you need to fit your personal circumstances on. Am I trying to fix a tax thing? Am I just trying to create income that's not with my own hands in my dental office? Do I not need any of that? And I just want to have something that's got opportunity 5, 7 years from now. It's not spitting off any income today, but the upside on the back end is that much greater because I'm not taking any money out today. So those are the types of things that we're discussing and showing in the group through solid people who have a network of opportunities to show dentists and high net worth individuals who could benefit from something like that beyond kind of the 401ks and paying your kids and home office things and all the things that you should do first that are really easy and definitely advisable to do for most practice owners. But once you've filled up those buckets and you're making, I don't know, $500,000 or more, there's only so much more you could do in those buckets. They're pretty full. So when you're looking for something more, that's where this type of stuff comes into play.
So for someone like me, who's like this constant optimizer, like sometimes if I say, hey, this thing is marginally better than this other thing, I don't know if it's a bad mental thing. I've had to stop myself to be like, okay, well, I'm just going to all in on that. If I see an edge, if I see positive EV, I'm just going to push it. That's how you can get ahead. And maybe I make the wrong choice, but if it was positive EV at the point of decision, then I can't be upset if the results were not optimal. It's just that I went with what information I had at the time. To the people that are listening right now, and like you said, you're not a financial advisor. I'm not a financial advisor. I'm a CPA, which is not a financial advisor, to the surprise of a lot of people. In terms of using this, is this your play money that you're doing this with? Or did it start out as play money and move into a bigger percentage? How do you get around in terms of like deciding at what point it happens? So you mentioned doing the normal things, the 401k, maxing it out and things like that. But how would you describe the average dentist should probably even consider alternative investments? One thing that I don't think you're afraid of is risk. I think that's something that we've probably established here. You're willing to take the risk of, hey, if I fire this person and it's hard for me to find somebody for 6 months, I'm going to have to deal with it. Whereas a lot of people that I talk to every day, they are afraid of that risk. So to the person who is afraid of the risk, or the average person, like, is this something you say, hey, probably best off just going the normal route? Or is there like maybe a certain percentage of what they have that you would say is worth like going around with? Or what are your thoughts on that?
Everything has inherent risk, obviously. There's no way to avoid that with anything you do in life, whether it's driving to work every day and the risk of driving your car and all that kind of stuff has risk. But you don't think of that as being a risky activity when you're doing it. In the same way, I felt like I've tried to distill down and find the right people who have limited the risk on the opportunities that we're talking about in this group. That said, there is risk in everything you do. Some of the things that I would say are risky, we haven't even talked about, and there are things I'm just doing personally, individual things on Robinhood and just play around with a few $1,000s here and there. That's the play money. That's the risk stuff. This stuff that I'm talking about is honestly a layer on top of the strategies of all the kind of normal, quote unquote, safe things that people are doing to just optimize their tax planning when it comes to being a dental practice owner or a practicing clinician. It's just a kind of a layer on top of that's not often talked about because there's not a lot of systemic money in selling you these things. People want to talk about Schwab and Fidelity and Vanguard or whatever they want to do because there's a lot of advertising around that, and you see it on TV and in the middle of your football games and all that kind of stuff. And so people have that kind of top of mind. they're not usually creating commercials to sell things to the top 1% of earners out there. And so that's why this feels a little foreign to some people, because it's just not out there broadly, but it's available. But again, the contrary, kind of to what you're asking with the risk, there are tons of people who do direct to consumer versions of this. And part of what that setup allows them to do is it avoids some of the registrations and vetting that the government requires for some of the higher quality stuff that's out there. And so even the better stuff is almost behind a veil, if you will, of having more compliance and all that kind of stuff, where they're not allowed to just put it out there on Facebook and have sponsored ads and hope that you click on it and send them $100,000. Like, they have to know you. They have to honestly consider your diversification, which is why I wanted to partner with the right people here. Like you said, if you find the thing that's the best thing out there, they're not going to allow you to just back up the truck and put everything in it, because that's not prudent to do that with your money. So they'll learn about where you already have money, what your liquidity is, what you're trying to achieve. Maybe there's a game plan over the course of several years, so you're not even deploying it all this year, things like that, where they have certain criteria based on their credentials that require them to do certain things, where if you just respond to a Facebook ad about whatever, wells or mobile home parks or whatever, that person on the other end, their job is just sell you on the thing that they're doing. They don't care about the rest of your portfolio or your risk tolerance or any of that stuff. If you want to write them a check, they're going to happily take your check. So some of the kind of nuanced things that people just don't understand and they should keep in mind is those people, I'm not saying that product is bad. That might be a home run for you, but they don't have all the perception and the kind of global perspective that they should have to truly give you optionality and diversification. And like I said, this is a layer on top of the other things you're doing. And so for me, a lot of people think about diversification as just, I need a whole basket full of stocks, whether it's an index fund or a handful of different stocks, and that's my diversification. Well, that's diversification within that one asset class, but it's not diversification across all types of assets. I think people should consider things like real estate and oil and gas. And even within real estate, there's several different options, whether it's single family homes or apartments or mobile homes or whatever. So there's all sorts of ways to quote unquote diversify. It's just a matter of how broad do you want to go? How much money do you have? What are you trying to achieve here? And all that kind of stuff. And so that's where having a conversation with somebody who is willing to learn that about you and then suggest to you the things that make sense for you is the way I would go if I was doing it.
Yeah, and I appreciate that perspective. My perspective as the CPA, I think it's also really important and critical for us to talk about the fact that some of these alternative investments can be really bad. Because if you think about the nature of these things, is that they are out there looking for capital to do a thing, whatever it may be. With the internet and the social media and the connectivity of everybody, it's easier to raise funds now through, crowdsourcing than it has really ever been before. And so the barrier to entry to that is not as difficult as it was, say, 30 years ago. And with that, bad actors do come into the space, right? Because we're in a good economic time right now, which means that funds are more readily available. Capital is more readily available from higher income earners. And honestly, we're all probably looking at the stock market being at all-time highs and being like, do I really want to put more into that right now, or do I want to try and do something differently? And again, there's people out there that know that's happening, and they're out there to get your money to do something that I wouldn't even maybe put it down as saying it's a scammy or nefarious. They have best intentions, is they may not be good at what they do. But from the CPA perspective, we do see the results of that, like on tax returns. Like, hey, someone put $100,000 into this thing and it went belly up and they lost all their money, and they basically just didn't get anything out of it. So like there's a 100% loss risk on some of these things. And there's other things that are more traditional funds. Like you've got this big company that's, hey, we just need capital. We don't want to go out there and find a bank to do this debt. We prefer to have capital investors, and this is just how we've always done it. And those things can be better. I'm just going to give you a quick rundown of kind of the 4 things that I tell our clients that I am always wary of. There's 4 main categories of this. Right now, this is talking about specifically with investing things. There's some people that look at this space and they are only looking at the tax pieces of it. Like they're looking for a tax break, not for an investment, which is odd because I think at this point, the market's sophisticated enough in most dental spaces to say, hey, you shouldn't buy that $100,000 piece of equipment just for the tax break. You should buy that $100,000 piece of equipment because you need that $100,000 piece of equipment. You can't spend your way out of taxes But for whatever reason, people go into the alternative investment space very regularly looking to spend money to save money in taxes, which that's a backwards way of thinking of it. So with that context in place, there's 4 categories of these investments I tell people that we're always wary of on the CPA side. And that's anytime there's some type of leveraged charitable return. In other words, I put $100,000 in, I get $400,000 as charitable deductions, right? So you've took $100,000, you leverage that into 4x deductions for what you put in. That is ripe for tax issues. The most common issue with that was syndicated conservation easements, or have had a lot of issues with that. The second is when there's any type of insurance product as a part of the investment. Again, this is one of the things that it's weird to see history repeat itself, but whole life insurance is a thing that a lot of people sell. And a lot of people, rightly so, think, hey, it's just a commission game. Like they're trying to sell you something that doesn't exist. There's a lot of schemes around whole life insurance that are things like, oh, universal banking and like infinite banking. They've come up with all these different terms for it. But at the end of the day, everyone's caught wind of those things not being the best idea. And so they obviously lean away from them. But for whatever reason, when the tax game gets introduced, some people think, oh, maybe that's the reason we should do that. So anytime there's insurance products involved, even sometimes with things like captive insurances, we've recently seen people doing dental warranty insurances, like where you start an insurance company to issue dental warranties to your patients. And it doesn't seem like it's probably a good idea. The third thing is anytime there's a really complicated entity structure set up, like, oh, you're going to pay us $10,000 to set up this pyramid of entities, and you're going to put money into a trust and all these other crazy things, that can usually be not a positive return. And 4 is anytime someone says, hey, I've got this thing you can invest in. It sounds like it's a passive activity, but it's actually active because we're going to do some fancy like trickery to say it's active so you can actually deduct it against your personal income. Those 4 categories are like the areas where we find a lot of misinformation and a lot of bad actors that are out there to sell you something that may not exist. So those are the 4 things I've seen. And while I see those things and all those are in kind of the alternative investment category or bucket, I do realize there are good opportunities in this space. And so I'm torn between on the CPA side of being like, hey, I see these people that are selling something that isn't really what they're saying it is. And I've also got these other things. So as a CPA, it's hard for me to recommend this as a product for my clients. Number one, I'm not an investment advisor. Number 2 is because of the fact that I've seen the negatives go along with it. And it's hard to say to 400 clients, hey, this is an idea for you. In terms of that, what other issues have you seen in this space? What other things should you shy away from? And if you want to talk to me about what you think the CPA's role is in all of this as well, I'm always interested in hearing other people's perspective on that too.
Yeah, I was taking some notes here. I think you brought up several good things as far as what people should be aware of. Honestly, I'll skip to the second one, which is the insurance thing. You said it kind of comes full circle. I think there are some creative branding things that are trying to change people's understanding or perception of what's going on. But I think honestly, most people who end up with an insurance product as an investment or are sold that are young dentists. They literally are letting them into the dental school to chat with you about life insurance, and it evolves into whole life insurance. And you get sold on this thing before you've ever really connected with enough people to tell you to do something differently. And then you get 4 or 5 years down the road and you surrender the policy because you realize you were sold something that wasn't what it was as far as what it could do for you and how expensive it was going to be long-term and all that kind of stuff. So I see that all the time with a lot of young dentists, usually in the first decade, maybe in the first 5 years of practice. Some people have those things and they end up getting rid of them because they're just not what they were sold as far as what they could do for you. Specifically on that first thing, the charitable thing, obviously you're talking about conservation easements. And then the most recent iteration of that was called a fee simple. They had similar properties and what they were going to do for you and all that, but both have been super red flagged by the IRS. It's not even like a gray thing anymore. And unfortunately, it's literally in the code. That's the unfortunate part, is it was allowable from a IRS code perspective, but the way that people were using them and taking advantage of them from a, like you said, a syndication standpoint ended up flagging them so much that I guess you could probably try it, but it's probably not going to survive the tax year that you're in to actually get to the finish line and get some sort of tax deduction. I know a lot of people are paying back taxes and penalties, and they're actually still coming out ahead because of the tax they're paying on it's less than what they would have paid on it originally, but that's a different aside. But yeah, those things are no longer a thing really fundamentally. The warranty thing is interesting because I was actually pitched that the other day, not as a product, but as an investment, like do you want to help fund this opportunity. It did sound complicated. It was interesting as far as just being different. I was interested to hear more, but I wasn't interested in it from giving them some of my money because I felt like it wasn't simple to understand. It was very complicated with a lot of arrows to this bubble and this bubble. And if it's not simple and I can't understand it in a 10-minute conversation, I'm probably not interested. I guess the thing to answer your question about what else should you be looking for me, what I've learned over the last several years is I want somebody who's been around a while. And unfortunately, you can't have been around a while without being around for a short amount of time. So those people have to somehow get to that point. But I want them to have seen a down cycle in whatever field they're in, whether it's oil tanking and going to $0 like it did in COVID or real estate crashing or whatever. Like I want to see that their business model is sound and that they aren't just succeeding in almost in spite of themselves because the market's good and interest rates are good and everybody's making money. A lot of that happened in the last half decade. Everything was favorable environment and then rates went up and maybe they had a floating interest loan, variable interest loan, and now they've got to refi that and it's higher than what they had before and their cash flows and their operation can't support the debt. And that's where things are starting to go south for some people. And whether it's apartment complexes where they have these short kind of turnover notes that they have where they expect them, they kind of project them to recapitalize or refinance at a point where all that goes down or they get long-term financing or they sell before they ever really have to do all of that process. And if all those things don't align, the business itself, and obviously there's still risks that can go bad in any business that you just can't foresee, but those are some of the things you could foresee. And those are the people that I don't want to be associated with. So all the things that we talk about in Legacy Point are people who are 9 and 10 figure operating companies. Like they're massive companies with a ton of history, usually multi decades. They're brand names you've heard of. If they're building a hotel, it's a Hilton or it's a Marriott or whatever. Like it's not just some mom and pop or somebody that's regional who started doing this 6 or 7 years ago and they're doing single family homes in Oklahoma or whatever. They're national. They understand markets. They understand cycles. They've got the ability to survive ups and downs. Like those are the things that matter to me. Even if the projections don't end up being the reality, I want the reality to still be better than going to zero. And so those are the things that I'm looking for when I'm looking for who to partner with and give my money to moving forward is those institutional opportunities when it comes to the investment itself.
You mentioned partners and operators. There was fairly recently a pretty big issue with some operators being a part of a group that we'll not name specifically that ended up being Ponzi schemes or just scams. So do you guys actually vet these operators or is that considered something different than what you guys do with these people? How would you frame that? How comfortable you are with these people?
The people that I've partnered with to bring the opportunities, like I said, they've got the credentials, they've got the background, they've got the education in this field. And so I've just aligned myself with those experts. They and their firm do hundreds of thousands of dollars of due diligence, whether it's at the criminal level of the operators, the personal financials of everybody involved. They'll have a tax opinion or a third party opinion on the deal itself. Do these numbers make sense? Do these projections make sense? Will it do the tax thing that they say it'll do? And so they get all these third party, but they're not them. It's not even internal to them. And it's not you and I trying to make this decision. It's somebody who this is what they do and they're being paid to do it. And they don't have a care on what they say. If it's truthful to say that this is not good or won't pass an audit with the IRS or their numbers are not right, they've overinflated this or that. That's what they'll put in these due diligence reports. And those are available to this brokerage, this firm. Then they make a decision on if they need to either dig into that more or if they like the results and now can offer it to investors. And so that's all happening. I've heard, in some of those other groups that they kind of do that internally. And I'm not saying that they couldn't do that, but they're not experts in that. And I'm not an expert in that. So I go look at these opportunities as a dentist, as a potential investor. I've traveled to physical locations to see the construction site exists or meet the principals in the deal. But I don't claim to be an expert. I'm just one more layer to just have eyes on it and a perception of it from the dentist perspective to just make sure that I would put my own money in it if I either am or am considering it. But I don't claim to be an expert, and my opinion bears no weight from a legal or tax opinion perspective. So yes, to answer your question, there's a ton of due diligence, a ton of vetting, and it costs a lot of money. If you're not well capitalized and this isn't a big opportunity, then some of those steps get skipped. And that's where people get into trouble, is they don't want to spend the time or the money to really figure out if it's a good deal. It looks good on paper. They know the guy, or they've heard good things about the guy, or whatever. And that's where some people get in trouble.
Thanks for listening to the Tooth and Coin podcast. If you enjoyed the show, we'd really appreciate it if you could leave us a 5-star review as well as a written review. Your feedback not only helps us improve, but also helps other dental professionals find our podcast and benefit from the financial insights that we share. So thanks for your support, and we'll catch you in the next episode where we'll continue to explore the business side of dentistry.